Independence, a cherished and prized state of being, whether it's our thoughts, our speech, cultural choices, or our money. As India celebrates its 70th year of independence, have you thought about the relevance of financial independence in your life? Welcome to Money, 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 the Independence Day special. I'm Surabhi Upadhyay, and joining me on the show this week is personal finance expert Kalpesh Ashar. Kalpesh, it's great to have you on the show, and it's a good time to be talking about independence in the financial context. And you know, that's a thought that really crossed my mind. We take a lot of things for granted. We take liberty for granted. But explain to us what one really should understand when it comes to financial independence. Is it just about having money in the bank, or I'm sure there's something more to it than that?
So that's a very interesting term, financial independence. And to put it in real perspective, seriously, what I feel about it is that financial independence is more of a journey rather than a destination. Because at any stage of your life, if you are equipped with the right knowledge or the right equipment or the right know-about of what you're doing financially, I think you really won't struggle. And independence is always there for the taking. So I always see it as a process which is ongoing. And if there are certain factors which a person could imbibe, financial independence is always awaiting him.
You know, I'll give you perhaps my very simple definition of it as well. I guess it's and correct me if I'm wrong, but perhaps it's a way of realizing a lot of your life dreams. It's not just about the next, asset or the next car or the next holiday, but it's also about the liberty to really create your own life. Would you look at it that way?
Exactly. I think you're spot on, because basically what do we mean by independence is doing the things which you desire at that point of time. So having the right, artillery at your beck and call financially is when you would be able to realize your dreams or your goals.
So, well, let me tell viewers that we've made Kalpesh draw up a 5-point roadmap on how to gain financial independence, and of course to assess whether you are actually currently financially independent or not. So let me come to the second question first. What are the yardsticks that tell you that yes, I'm quite all right, I think I have financial independence?
Yeah, okay. So to start off the 5-point things which you mentioned, very frankly speaking, you start with something which is non-financial. So financial awareness leads the pack. And when you say financial awareness is something which can be further classified into two parts, which is the internal financial awareness and the external financial awareness. I'll talk about the internal part first, which is basically understanding your own financial profile at whichever life stage you are. And when I say understanding, is actually implementing your actions based on it.
So let's take this one step at a time. When you say understanding your own financial profile, what all goes into the making of someone's financial profile?
So basically the first part of it is understanding your income flow and what is your expense. Are you actually spending more than you're earning? Or is it the other way around, which is the thing to do? Second part is understanding what are your real assets.
Okay.
And more importantly, what are your liabilities? Now, once you have this picture drawn out, the thing is accepting it. Because what we've seen in our practice is that people really do not want to accept their real picture. And in that, many non-financial things like our emotions, envy, the act of comparing yourself with others, actually pulls a person down. And till the time he really doesn't accept his own profile, that this is where I am, I surely want to have a better, positive financial profile. But at this stage, I am bound by certain circumstances and I am bound to act in that manner.
Sure.
So that type of a realization is of prime importance.
So Kalpesh, when you talk about creating a personal cash flow statement, one issue that comes up is, the lumpy nature of both inflow and outflow. There might be 1 month where you've had a certain big expenditure, big ticket expenditure. It could be travel, it could be, refurbishment of the house. Another month could be fairly lean in terms of expenditure. So typically over how many months should you average out this statement to come to a true picture?
So the simple answer to that is annual.
Okay.
So what we also do when we chart out a cash flow for our clients or for anybody who requires this help is that whatever are your monthly expenses, we pan it out for an annual basis. So you get a clear picture. Like for example, a house renovation would be in fact recurring in 2-3 years for a person. It would not be a monthly or an annual feature. So even if whatever amount you are planning to spend at a 3-year period, we tend to make it on a monthly basis. So at least you have put that figure down in your cash flow and you're prepared for it when that actual expense arises. Now, the other aspect which you said about the fluctuating nature is that there again is a classification that if you're a salaried person, you know there is a fixed income coming into your bank account every month, every year, you get certain amounts. But for an entrepreneur or a businessman, that income is volatile itself.
Absolutely.
So you really don't know you can always average it out after a 2 to 3 year, you know that this is what I'm getting. But it's very difficult to determine it at one shot.
Okay.
But by actually charting out a cash flow, you might be 5 to 10% off and on, but at least you started the journey.
So Kalpesh, that's as far as the cash flow is concerned. You also mentioned another important word, asset and liability, which completes your personal profile. When it comes to valuing your assets or knowing really what sort of assets you sit on, what do you advise clients? Because there could be some old inheritance, there could be some old property tucked in somewhere, but does that really contribute meaningfully in terms of making your asset liability profile? What are the assets you should include and which are the ones which are probably illiquid, so they don't really materially matter? Okay,
so the simple answer to that is we classify it into financial assets and physical assets. So the physical assets would surely comprise of your real estate. And in real estate, very specifically, we keep aside, we do not include the house in which you are staying presently.
Okay.
Because that is an asset which you are not going to, under any circumstances, sell and make a net worth out of it.
Okay.
Or trade it for something else.
Sure.
So if you have in real estate, say a couple of other properties besides your residence, we include that as a part of your real estate portfolio. When it comes to financial assets, all the paper assets which we say, you can always start with actually including your existing bank balances, going to your fixed income securities, going into your equities in terms of equity mutual funds or direct equity if you're purchasing, going into small saving schemes, which is all your post office investments and the conservative investments. Again, coming down to the commodities. So if you have, say, for example, gold, which is tradable and bought the right way, you could always include that as your part of your assets. So that all is part of assets.
Okay.
And when it comes to liabilities, it's always the EMIs which are the loans which you've taken, the credit card outstanding.
Sure.
In certain cases, to be very realistic, if you have taken a personal loan from a friend.
And here is where I'm going to ask you, perhaps the most baffling question. We're talking financial independence. The moment debt comes into the picture, does it necessarily mean that I'm losing financial independence? Debt is perhaps not always a bad word, but how do you make sure that you don't cross the line and retain your independence?
So as a cash flow, we again go back to the cash flow, which I always term it as the nerve center of any financial profile. In a cash flow, say for example, you're taking a loan. We always advise that the loan component should not be more than 35% or 30 to 35% of your monthly income.
Okay.
So if people tend to, go overboard by having an EMI of say 50-60%, surely it would affect many of their other day-to-day things.
Okay.
So that's where we put a check that even if you are taking a loan, the eligibility should be such that the EMI would come to around 35% and not more than that of your monthly income. So you're plugging the gap there.
Okay, so that's a really important, thumb rule perhaps to keep in mind. We're going to take a break on that note, but we've only discussed the first step towards financial independence, and that's knowing your own financial profile. We'll discuss the other four when we come back. Welcome back. Here with the Independence Day special edition of Money, 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 where we're discussing the concept of financial independence. Kalpesh, so we've discussed the first step towards financial independence in our 5-point roadmap, and that's knowing your financial profile. Then the second, perhaps very important stage is setting your goals, deciding where exactly you want to be in terms of, a financial target.
Exactly, because a goal is simple. I just put a small analogy to it. It's like playing a football match. So a football player who probably works so hard, skillfully dribbling and shooting and passing all on his own with his teammates or as a team, you envisage a situation when he's in front of the goal. He's done all the hard work and he sees in front of him there is no goalpost to shoot at. So it's absolutely necessary that you have a goal. And goals can be classified very easily if you actually put your head to it. You include your family members into it, which is one more big step in financial
Sure.
independence. So set out writing goals. And in that, you start classifying goals by time duration. So you have a short-term goal, which we generally classify as, which is anything between today to 3 years.
Okay.
You have medium-term goals, so which could be time duration-wise, anything which could be 3 to, say, 5 years. To 6 years, and your long-term goals, which is more than 7 to 10 years and away.
So now let me quickly ask you a follow-up on this. I mean, it's always great to dream, but when you advise people, are there any upper limits or realistic caps that you set to these financial goals as a function of perhaps your current income inflow, etc.?
Yeah, exactly. So there's no cap to the dreams, but there is a cap on your profile.
Right.
So if you can't be just extravagantly thinking that if this is my profile, I could aim for X is to Y is to Z. So you should be realistic that where you will get.
Okay.
And that is where we even have to, unfortunately, tell people bluntly that please scale your dreams down.
So that brings us to point number 3. Again, to recap, number 1 is knowing your own financial profile. Number 2 is knowing your goals. Number 3, the external awareness, Kalpesh, that you spoke of, which is perhaps the marketplace or products. To what extent does someone need to be aware and educated financially in order to move on this path of financial independence?
Exactly. So when you talk about external awareness, that is something which you have to train yourself for. And you have to have a keen eye or an ear about it. So even if you are a professional in any field, not necessarily finance, you need to know ultimately about where your money is going. So for that, what we generally say, not as a professional, and we don't say that you should know the nitty-gritty of the financial world, but what we generally say is that he should at least know what are equity markets. If you put your money in equity, there's a certain risk. When you put your money in debt, there is a certain level of security.
Okay.
But the returns are muted compared to the equity. Then you stretch it forward, saying that you should know the roles of the institutions. So if somebody says the word SEBI, you should not be lost in a different planet. You should know that this is an institution which is for the protection of the investors. So this is the basic knowledge. RBI, what does the RBI do? What does the finance ministry do? I'm not saying to read the fine print of the budget word by word, but at least the finer points. And that is all imbibed by just putting yourself little bit, say half an hour every day to understand this. We have the whole world of media today exploding and telling us what is available to us.
Sure.
Because if we are not financially savvy, I think it's a complicated world out there in finance today. It's a jungle. And it's very, very possible that you will be misguided by a lot of people who want to, misguide you for their own benefits.
And perhaps that's why it's really important to understand the importance of an independent financial advisor as well.
Yeah.
Someone who's working for you and not necessarily working for those who are selling products in the market. All right.
Exactly.
That brings us to point number 4. And maybe this is the most difficult one, which is drawing up a plan. Where do you even start, Kalpesh?
So drawing up a plan is probably putting your cash flow in perspective, which I always say is the nerve center. And that gives you an handle of what that person is. Because be it a person who's earning 50,000 rupees per month, or be it a person who's earning 50 lakh a month, his income and his expenses will move in that parameter. So he should be able to know that if he is actually earning that much, is he spending within limits, or is he actually spending less, which gives him the leeway to actually invest more.
Sure.
Or worst come to worst, is he spending more than he's earning?
Sure.
And if he's doing that, how is the extra income coming? So it throws up a lot of questions. It's an eye-opening exercise. Cash flow is a must for anybody to start a financial plan.
Okay, I get that. And of course, a financial plan is a very individualized sort of, assessment of where one is, where one needs to be. But if I were to ask you to generalize this slightly for us based on life stages, if we broadly speaking take young working professionals who are between 20 to 30 years old, if we talk about a mid-age professional, and then we talk about the slightly older generation of people, how do typically plans vary? If you could give us a generalized view.
Yeah, so if you have a person, say, who's just on the brink of starting his career, or who's just stepped into a job or something like that, or an entrepreneurship, his type of planning would be more oriented towards growth, but primarily first protecting him at this age, because if he's a sole bread earner, he can easily protect himself through adequate insurance or something at a very, very reasonable price to pay.
Absolutely.
So that plan for a person who's stepping into the career, probably his capacity to invest is much, much more than a person at a different life stage of, say, 45 or a person on the brink of retirement.
Absolutely. Is there any sort of a thing or a rough rule which is kind of an savings to expenditure kind of a ratio? The reason I'm asking is that a lot of younger people are looking to live for the day. You know, it is here and now. You enjoy your life right now.
Yeah.
So how do you know how much to invest and how much, you know, you are at liberty to blow away and perhaps enjoy your present?
So there's a further redefinition of that also. So there's a difference between savings and investment.
Absolutely.
So if you just save and be happy about it, that this is the money lying in my bank account, I'm sorry to say it's a big mistake. But if you invest that money prudently, that's a better option to do for the long term. And the percentage, or if you want a thumb rule of that, we always advise that after all the expenses have been taken care of, you should at least be able to start with 20% of your monthly income going towards pure investments.
Okay.
So 20% is a start-off point. And that is where you need to control the lever there, that if I can fine-tune my expenses, I could probably be investing more.
Okay. All right. But at least 20%
At least
every
20%
month.
every month is a good benchmark
Starting
to start
point.
with.
All right. So
Yeah.
that's again something to keep in mind.
Exactly.
We'll take a break on that note and we'll come down to the last important milestone on this journey to financial independence: protection, insurance. We'll talk about that on the other side. Welcome back. You're with the Independence Day special on Money, 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 where we are discussing the concept of financial independence. Kalpesh, so we've drawn out 4 points, and I'll quickly recap for the benefit of our viewers. Number 1, know your financial profile. Number 2, know your goals. Number 3, know the market, know products at least a little bit. Number 4, start drawing up a plan. That brings us to number 5, which is ensuring that you are adequately protected. Do elaborate on this point, Kalpesh.
Very, very necessary, because I think independence should not be, confused with protection. So this is a must, because here you're talking about protecting your family. What if you're not there? And that has a very, very relevant context when you say in terms of insurance, which at times is missold. So if what we generally advise people is that if they have already started on the investment journey, they are earning something for their families, they have to get themselves adequately covered. And for that, we've said it on various shows, various forums, various articles, term plan of an insurance is the best product to look at.
Okay.
And the parameter, there are various actually intricate parameters when we actually determine what is an adequate cover. But to start off, we can generally say that 10 to 12 times or 10 to 14 times of your annual income
All right.
should be the cover which you should be you should have your life insurance
Okay.
through a term plan.
Okay.
So ideally, if you're earning say 10 lakh rupees per annum, you should have a cover of approximately say 1 crore or 1.25 crore for sure.
Okay.
And we all know, I don't want to repeat it, that the premium of a term plan is probably 8 to 10 times lesser than any other traditional plan or an endowment product or a money back product, which is going on in the market, and some people
Absolutely.
fall for it.
Yeah, I guess term plans are just the purest form of and simplest form of insurance
Exactly.
that there would be for life insurance. And then, of course, there's health insurance.
Yeah.
Let's not forget
Equally
that in
important.
today's environment, health insurance also would be extremely important. Kalpesh, but let me ask you this question then. Coming back to the cash flow then, in terms of expenditure, along with all your other expenditure, then, of course, all the premiums that you're paying for buying this protection, they would also go in. So again, a rough thumb rule, you mentioned at least 20% of your annual income should go towards investment. Then again, how much should you allocate for premiums? Because there are a lot of policies sold, and sometimes we end up getting confused as to how much of premium can we really afford.
The sum assured is also determined by a financial profile.
Right.
And if your suitability in the cash flow is there, obviously if you take a term plan, like I just said, that the premium is going to be 8 to 10 times lesser. So just to cite an example, for a 25-year-old, a 1 crore cover would not cost more than 5 to 6,000 rupees, which is nothing more than 500 rupees per month.
Sure.
And I'm sure anybody who's earning 10 lakh rupees can afford that. Similarly, for the health insurance, so we always advise that you should be covered individually. So if you are living in a metro, So the medical costs are higher, so you should be covered accordingly, like, you know.
Why do you say individually? Because health insurance is also being sold as, you know, a lot of group plans which are there in the market.
Yeah, so there also that the family floater concept.
Family floater,
the family floater concept which you're trying to say is probably putting 3 to 4 family members together. And there, if, like, you know, there's a calamity or a requirement of a claim coming up, we don't want that to be taken away by one family member.
Right.
So as far as possible, I'm not saying family floaters cannot be taken, although they are a bit cheaper than an individual plan also. But individual plan gives a person a proper security of his own medical needs.
Sure.
As such. So family floater, as long as he's covered adequately. Because again, coming to the concept of cash flow, that in case you're not covered adequately on the health front and you're admitted to a hospital, the bills, if not, will really take the steam out of your cash flow.
Yeah, it'll throw everything completely out of whack.
It'll take the steam out of your net worth also.
Yeah.
So a simple, like, sum assured cover, if affordability is there, take it to the maximum, and that won't hamper your cash flow, I'm sure.
Absolutely, it is. Kalpesh, thanks so much for joining in and sharing those thoughts on financial independence. Well,
thank you.
We hope that our viewers have had something to take away from some of these very, very simple yet very, very important points. Thank you for watching. We wish you all a very, very happy Independence Day.